Hi, good morning, everybody. Thank you all for being here. Appreciate the interest in this fascinating topic of long-term investing. We have an incredible panel here this morning. We're going to ask each of them just to give a couple of minutes of their unique perspectives. I myself am a partner at Generation, which is a sustainable investing asset manager that was founded about 12, 13 years ago by Al Gore and David Blood. So we are known as the Blood and Gore Fund by some people. And, Al has spoken here before, as has David. This time it's my turn this year. But we as sustainable investors obviously do take a very long-term view of the world. In many ways, we are facing sort of rampant short-termism in our culture and society and economy in many ways. And, trying to solve the short-termism with the need for long-termism, the benefits of long-termism, in particular when it comes to investing, is what we want to talk about today. And in the prep call, one of the guys was saying that, you do obviously have the benefits of long-term investing in terms of compound returns, but you obviously have the illiquidity problem. And you also have an issue where asset managers, many who want to be long-term, many believe that they are Warren Buffett, even though they're not. And, you have a skill gap in terms of locking in capital for the very long term as well. So we're going to touch on a few of those issues. But let me just quickly say who's here on the panel. So from Hamilton Lane, we have Brian. From MetLife, we have Steve. Jingdong from the IFC. Jean from Wellington Group. And Arif from the Abraaj Group. So maybe I could just start with you, Brian, and maybe ask to give you your perspectives on where you're coming from a Hamilton Lane perspective.
Sure. So I'm Brian Gildea. I'm a managing director and investment committee member at Hamilton Lane. Hamilton Lane is a global alternative asset management investment firm. We invest only in the private markets, which will color a lot of the perspective that I share today. So I think relative to some of the other asset classes, we have the benefit of being considered long-term, although I think part of the perspectives we'll share today is even there, really we're talking about most assets being held for 4 to 6 years. So there's certainly some structural benefits to our asset class. Illiquidity is one of the things that go with that has helped the asset class outperform. But there's some challenges still as well. And I think that the key challenge I'd like to highlight to the long-term investing is the way that we measure the investors. So if you're a pension fund and you're being measured and you're being evaluated, it is very hard to take a long-term perspective. The incentives and the measurement framework just aren't there today to really encourage that, except for a handful of some of the largest, most sophisticated investors. So I think that's one of the big challenges.
Great, thank you. We're going to just go
down the line.
Yep.
Good morning, everyone. I'm Steve Goulart, Chief Investment Officer for MetLife. MetLife is one of the world's largest life insurance and group benefits companies. And I think when you go through the panel here, you'll realize we are primarily a fixed income investor. But I guess I'd step back for a minute, though, and just on the topic itself about long-term investing, why is long-term investing important? And I think there have been a number of research reports and analyses that show that long-term investing is critical because it stimulates GDP growth by really sort of stimulating economic activity in countries. And of course, that's critical when we've been mired in a low GDP environment for the last 7, 8 years now, basically. So I think that emphasizes why it's critical, and I think we all come at this from different perspectives. As I mentioned, we're primarily, a fixed income investor, but I really think of us as a liability-driven investor because that's what really dictates how we invest. And if you think about what we do, we sell insurance. A lot of the insurance we sell may be very long-term insurance, life insurance, long-term care, pension closeouts, structured settlements, that sort of thing. And from our perspective, what we need to do is really think about our ability to cash flow match a lot of those liabilities. And that's what's driving how we invest. That's why we invest in fixed income. And the other component of it is we're a highly regulated business. And we have to hold capital for every investment we make based on the riskiness of that asset. So equity doesn't really fit because it's a very high capital charge as well as the cash flow predictability isn't that high. So we'll do a small amount of equity, but basically it's all fixed income. And so that's what we really look for. Again, we need long-term assets for the long-term liabilities. When we think about the market, of course, we're going to invest in public fixed income assets. but that doesn't really provide enough supply for us, and what we really do is try and find whatever asset opportunities exist. And so that has taken us into private assets, where we do things like commercial mortgages, ag mortgages, but even in those sectors, you can't get longer than 10 or 15 years, and we need things that are even longer, and that takes us into private debt from corporations, and as I'm sure we'll get into, infrastructure, which is obviously a very attractive asset class to us as well. So I think I'll stop there with just that background.
Thank you very much. Would you like to continue from the IFC's perspective?
Yes, thank you very much, Colin. Good morning, everyone. For those of you who don't know IFC is part of the World Bank Group that exclusively focuses on supporting the private sector. So this year, we celebrated our 60 years anniversary. And just to let you know that in the 60 years, we have invested from our own balance sheet over $200 billion in over 6,000 projects in 120 countries. And we directly crowded in another $50 to $60 billion commercial co-financing and catalyzed about $1 trillion in those projects. And we are rated AAA, while our overall exposure in emerging market from equity, mezzanine to senior debt is a credit quality of single B to double B. And we have never had an operating loss on our balance sheet. So as a practitioner, we have evidence to show if you do long-term investment in emerging markets, if you're patient capital, if you diversify your investment across many countries, you will achieve a very attractive, reasonable rate of return. So I think for a US-centric audience here, I think the call out, as my president, Dr. Jim Kim, has been saying in this conference, is that we want to partner with you, and we wanted to use our balance sheet to de-risk so that the project will be attractive to private sector investor. In emerging market, the annual gap of financing is about $3 trillion. And all of the financing actually do about 50% of it. And of the 1.5 trillion, private sector is only about 20%. So imagine if we increase that 20 to 30%, we will reduce government debt, we will make projects more sustainable, and we will offer an alternative asset class to institutional investors all across the world.
Great. It's an impressive story. Thank you. Jean.
So I'm Jean Hynes. I am managing partner and portfolio manager at Wellington Management, which is a $1 trillion asset manager and mainly public equities, fixed income, and multi-asset products. I specialize, so my perspective on the panel is I'm a healthcare investor. So healthcare is I consider it a very long-term, very long cycle industry. So I will be able to offer perspective on what it's like to invest in companies that have inherent volatility, and how do you invest in a very low turnover strategy when you have a lot of volatility in the underlying markets of these companies. As managing partner, I'm also responsible for how we compensate our partners and managing directors, so I can also offer perspective on how we as an organization think about incentivizing for long-term investing.
Thank you. Arif?
Good morning. My name is Arif Naqvi. I run the Abraaj Group, which is the largest investor globally in emerging markets. I'd like to just start with the term emerging markets because we call them global growth markets. 2/3 of the world's growth is going to happen in these markets. The majority of consumption is going to happen in these markets. And to continue to call them emerging markets is a bit of a misnomer. And what I'd like to do is I'd like to tie in this discussion around long-term investing with why growth markets continue to need that particular category as just opposed to investment per se. And I'm going to pick up from where Brian left off, actually, from the perspective of private equity. And what I'm going to say is not so much focused just on emerging markets, but across the spectrum of where PE investing takes place. The first of which is, it would be a fantastic world where we all lived inside the minds of analysts, and we could build entire value creation cycles by pressing a button on a computer once we've built the model. But it doesn't work like that. In the real world, value creation takes a lot of time. And value creation is all about people, it's about effort, it's about capturing the inherent capacity of a business to grow over a number of cycles. And to do that, you cannot be subjected to short-termism, to quarterly earnings, and to the scrutiny and glare of the public market evaluation on a quarterly basis all the time. So that's a very, very important point. The other thing from the perspective of global growth markets is that we're not just looking to build businesses with strong business models, we're also talking about creating the product category, and that in turn takes a long time as well. And whether you're pursuing growth drivers or cost control measures or whatever, all of this takes a period of time before it comes through and shines in terms of totality. Second point I'd like to make in the introduction, and then I'll stop, is that let's look at the big picture as well. Go back to 1900, the average life cycle was 31. Go into 2000, people born in that year can expect to live to the age of 100. So we've tripled life cycles, we've tripled and had the luxury of building businesses and opportunities over a longer term time horizon, and we can certainly create more value and create a more lasting business if we allow it to nurture itself over a period of time. And as the runway has gotten longer, there's a tendency among some investors to actually become more short-sighted and short-termism in nature. And what we should be doing is the exact opposite, and looking to see the what, the how, and the why that we can go through. And I hope we can spend some time talking about that.
Great, thank you. Those introductions make me feel that we should have had half of the panel that were advocating for short-term investment and half long-term, because I think we don't have a lot of disagreement amongst this group in terms of the value of long-term investing. But I think it is, one of the things we wanted to do was to try and tease out some of the barriers to kind of more long-term investing, basically. If it is just really common sense to invest in the long term, why is more of it not happening? And why is there still a bit of a gap in terms of capital flows into truly long-term situations? And we wanted to pick up initially on the question of sort of incentives, which is somewhat tied to the structure of the investment vehicles that different people are working with. Just from the perspective of generation, in our public equity business, we have a 3-year performance fee, which is sort of, meant to be designed to incentivize our portfolio managers to be doing longer-term investing in global equity markets. On our growth equity business, we obviously run a very long-term traditional private equity structure, which incentivizes long-term performance as well. But we often hear from LPs that there's not that many asset managers in the world that are truly putting in place incentive systems to incentivize long-termism. So I'd appreciate the panel's perspectives on either structure of the funds that you're using or investing in, and what the incentive structures look like, and what innovations you've seen around pushing for long-term investing. Brian.
Sure, yeah. Happy to start with that one. I think on the fund structure, so talking about private equity in the private markets, I think that fund structure is a huge benefit. So when a manager like Arif has capital, he knows he has it for a fixed period of time. He can buy a business, he can make the changes he wants, he can sell it at the time that he thinks is most appropriate to really generate that value creation. That's worked really well for the asset class. So you could pick your time frame, but over a 10-year time frame, the private equity markets have outperformed the public markets by 480 basis points. And a lot of it is due to that structure and the value add that those managers are able to generate. So that works really well from their perspective. But the challenge comes from the underlying investor's perspective. So if you're a large pension fund and you're being measured quarterly on your results, then it's very hard to take a long-term approach. Yes, 10 years from now, you'll know that that was a good investment that had done well. But there are very few organizations that really have the governance structure and the incentives really set up to enable them to be measured over those same types of time frames.
So you're saying it's the asset owners who have got the wrong structure, and that trickle-down effect is the problem?
I think very few of the asset owners have the right governance structures that are set up to enable them to really take a long-term perspective. Even if they have the right liability, the ability to withstand longer duration, their structures may not be set up exactly to do that well.
And why do you think that is? I mean, given that they're the ones with the long-term liabilities that they have to match, why is that not changing? What is the problem?
Well, so as in one of the earlier panels, one of the Canadian groups actually spoke about having the right governance framework to really incentivize and think about the long term. So often you might not have the right constituents involved in those decisions. You might not be able to retain staff. You might not be able to pay the appropriate way. So figuring out ways to address that challenge for a lot of the big investors is really an issue.
Mm-hmm. Mm-hmm. Interesting. And what do you think the role of the kind of advisors are and the consultants are, sitting in between the manager and the asset owner? I mean, can you give a perspective from there in terms of trying to change the incentive structures? Because, people have raised questions about the incentives for advisors as well, obviously, and how that fits into the whole long-term investment.
Sure, yeah. So I don't think it's the role of the advisor to step in and change the governance structures or make recommendations around what those institutions are doing. I think those are their choices that they're thinking through. Obviously, sharing information or ways around structures that seem to be working is part of the ecosystem. But I think it really comes back to recognizing that there's a benefit to having long-term capital and making long-term decisions and trying to structure your organization the right way to do that.
Mm-hmm. Great, thank you. And I know at Wellington, you guys have got a very interesting long-term incentive scheme. Can you talk a bit about that?
Yeah, so many of our clients pay us fees in different ways. Some have performance fees and some have fixed yearly fees. But inside of Wellington, all of the investors are compensated based on performance. And 50% of it is on 5-year performance, and 25% is on 3-year performance, and 25% on 1-year performance. And what that means is that we're very aligned with our mission, which is to produce excellent returns for clients and produce alpha for clients. And so Wellington could collect a fee, but I don't actually, I'm incentivized to produce alpha for the clients long term. And what that means is that I don't, as an investor who's running portfolios every day, don't worry about what I do in December. I know a lot of other investors that don't have the same kind of structures worry about year end. And all I worry about is what kind of investments. I'm thinking about investments for the long term. What are the best investments for my clients for the next 3 to 5 years? What's going to generate returns? And I'm not focused at all, or never had to be worried about short-term performance. So I think that is very beneficial for an investor who has to deal with the volatility of markets.
And you, I mean, at Wellington, you've obviously got a fantastic track record, and that affords you the luxury of having LPs who give you that time. But you're one of a small group of public equity managers who actually has that luxury. Yeah. I mean, there's a system-wide problem, right, where if you don't have that track record, it's very hard to actually, kind of put in place that kind of structure. And your LPs are kind of allowing you to do that, right?
Well, I think it all starts with our own structure. So our own structure is a private partnership. We've been a private partnership since 1979, and we're aiming for it to be a perpetual partnership. So the way the partnership is structured is again a generational transfer. We allow generational transfer so that we will be a surviving organization for hopefully the next 40 years, the next 100 years, and that just allows us to think really long term. Mm-hmm. So when we're thinking about where we want to hire investors and we're thinking about how we compensate investors, it's all about talent. Mm-hmm. And I guess we have the luxury of that because I guess we're very thankful for our founding partners who came up with that structure. So I would say we really, really benefit by the way we're organized from a governance perspective. Mm-hmm.
Interesting. And the structure that you articulated there, that is all for the public equity side. Do you do anything else in any other asset classes where there's different structures?
So we're mainly, most of our assets are in public equities and public fixed, but we do have an emerging business in sort of right before pre-IPO. Right. And that is very typical. That structure is very typical to another PE firm, where it's very long-term.
You have a separate PE fund to do that?
Yes, a very long-term structure.
Got it, great, interesting. And have you explored the notion of sort of permanent capital, evergreen funds, and that kind of notion on the private side?
I think we're early in our evolution about thinking about that, but we hopefully have the talent to be able to do that, but it's something we're interested in.
Great, okay. Arif, do you want to talk about your perspective on incentives?
Sure. If I may be a little bit provocative on the subject, I don't think it's a subject just around incentives. I think the issue around short-termism or long-term investing is a little bit more fundamental. And it's easy to talk about just incentives, but the reality is that managers come to work not just around the inherent necessity to produce returns and thereby to earn for themselves an incentive fee. I think today it is a little bit more than that. And I think more and more of the great businesses that are being built around the world are proving that, whether they're in the new economy space, in the technology space, or in consumer goods and services, logistics, you name it. And what I mean by that is that great businesses today are the ones that are fundamentally addressing societal challenges. Right? And that's an important point to start with. I think it's a little bit too narrow and too selfish for us to think just of fund managers, incentives, and thereby returns. I think the best firms in the world are the ones that think about society's challenges. I think they look at incentives because it's our job to produce shareholder returns. But at the same time, we have to look at stakeholder returns as well. We have to look at the wider environment in which we're operating. And most large firms, by the way, have the capacity to compensate their employees by a variety of means, not just by incentive structure. So that's the first point. And then the second point I wanted to make was it's not just that, but it's actually the way in which our legal structures and our thinking is based as well. So for example, if we look at risk, okay, we need to have a fundamental realignment of our thought processes around what we consider to be risky to start with. Let's look at, for example, infrastructure. So I know this is something that's very close to the IFC, and it's a very interesting way of illustrating the case in point. If you look at African infrastructure, you look at 5,000 projects around the world globally over the last 30 years, the default rate, the risk rate in African infrastructure projects is 1% compared to North American default rates at 9%. But that doesn't mean that we all consider North American investments to be riskier. It's the way we perceive things. So I think we need to relook at incentive structures. We need to relook at the way we define risk and our perception of it. We need to relook at perhaps permanent capital vehicles, but we need to stop and not think that whilst in a world that is changing from every perspective, the top 5 companies in the world were not in the top 5, they weren't even created 25 years ago, right? So everything is changing all around us, and yet we're married to the same box structure of how PE investing or public market investing is being looked at. There is a margin, there is a fee, there is a hurdle. I think we need to relook at a lot more of the parameters than just incentive.
Great. Thank you. Steve, you wanted to jump in?
Can I jump in on something? I think you've heard incentives from both the speakers, or all three of them, which I certainly would agree with. The incentive structure is important in making sure interests are aligned. But I also want to dispel one notion right away, which is private equity is not a long-term investor, okay? I mean, the average fund is, 5 to 7 years maybe. In my book, that almost gets to a medium-term investment in the way we think about investing. So it basically, it's constructive ownership, I would say that,
by the way.
but I wouldn't call it long-term investing because, again, the time horizon, when compared to how I think about long-term investing. That said, I'll come back to incentives. And again, incentive structures generally are reasonably in line through carried interest, deferring fees, that sort of thing. That works. But when we think about long-term investing, I think that's thinking about ownership or debt that truly exists with a property or an asset for a long period of time.
And your long period versus 5 to 7 years is more like 20 years, something like that. Yeah.
Yes, absolutely. And in thinking about the concept of asset ownership, again, remember we're fixed income, so I don't own equity. I own debt though on the properties, but that's still a critical component of the capital structure of most of those. So I do view us as having a vested interest in the ownership, and in fact, there are a number of times when we're negotiating with the equity owner who wants to sell the property, move the property, and we have debt on that property.
Could I just jump in for
Very
one
helpful.
10-second response?
Please do. I think he challenged
10
you there.
seconds on that. And you're absolutely right, but I think it goes back to the earlier years of the industry where the pioneers on your side of the table were looking at the pioneers on my side of the table and saying, it's all very well to give you money, but I need you to come back and prove that you were good enough. Okay, so my 5-7 year cycle actually marries into your 25-year cycle because the people you're looking after are returns that you need to generate over a much longer horizon. It is the way the industry evolved. So my point goes back to, let's first differentiate ourselves from the public markets, which in my world are something I don't even understand. They're done by people who live on Mars. I can't imagine how you can subject yourself to that. That's okay. But the world in which I live, I am quite happy to work with your world and say, let's go into a more extended horizon, because today you've separated the wheat from the chaff. You know who's good and who's not good.
Yeah.
And therefore we can build a longer term horizon.
And we are starting to see the advent of new funds that do have longer term horizons.
Correct.
Right.
So can I make a couple of points from a project financier perspective? To institutional investors, especially insurance company and pension fund, they don't necessarily look for a killing return. They want long-term, steady return. And this is where in emerging markets, there are so many opportunities. So we have done about 50 billion loan syndication in our space. But I think after global financial crisis with Basel III, commercial banks' appetite to do long-term project financing has dwindled. So we started to work with insurance companies, and now we have created a vehicle where for insurance companies who look for long-term project financing, where we de-risk, we take a first loss. On a globally diversified portfolio basis, they take the senior tranche because they need to be BBB, they're regulated. So we are now working with 5, 6 insurance companies, because when we opened our book, they said, my goodness, the average return is no different than OECD infrastructure financing. As a matter of fact, our recovery given loss is far superior because we are patient capital. Colin, if you allow, let me put up a slide, very quickly, slide 5. If you can queue up.
There was some controversy over the use of slides. All right, so
Is it up?
he wanted to use like
Yes.
5 slides. I said 1, maybe.
Yeah.
So he put it all on one slide.
That looks like 4 slides in one.
Yeah.
Exactly.
This is how the IFC gets away with everything.
I just want to show you, for example, last year we just concluded one of the biggest project financing transactions in Ghana, almost $8 billion. Now this is where the de-risking vehicle of the World Bank Group plays such a powerful role, where the World Bank, who often lends to government, because of their country sector dialogue, the World Bank is able to design a security package and providing about $700 million enclave loan guarantee to the sponsor, where our colleague at MIGA provided political risk guarantee to commercial lenders, and IFC, my institution, was given the mandated lead arranger role to arrange the $1.35 billion debt financing for Vital. Now, what is the benefit of this project? So now we de-risked. World-class sponsors came in and did this project because offshore Ghana on this project found about 1 trillion cubic feet of natural gas that can power up to 1,000 megawatts of power, which is about a third of Ghana's power generation capability, and 130 million barrels of oil. So I think there are projects happening. And if you design it right, I think this is long-term. By the way, the IFC package and our direct lending of $235 million is 12-year senior debt financing.
And what is the yield on this? Do you know? Like, what are you promising to the
So let me
the
put it this
investors?
way. We do commercial debt financing, and we work with Abraaj, with Citi, with our colleagues. So the debt financing is purely commercial. So whatever the commercial bank, but because we de-risked, the merit for the project determines the return, which is commercial.
Got it. Great, thank you, appreciate it. So let's just talk a little bit about this kind of unpredictability of the long term. So, if people, with the innovation cycles around technology and societal change just kind of speeding up, you've got this strange kind of challenge around how hard it is to predict what's going to happen, in 6 months versus a year. And you've got some very deep long-term structural drivers like climate change and inequality and other things like that, which also have a very wide range of outcomes and also have very unpredictable outcomes. And so when you're doing a 25-year infrastructure project, how do you factor in things like climate change, for example? Or when you're doing a 7-year, kind of PE investment in East Africa, how do you structure in, social kind of breakdown risk or FX risk, for example. If you're doing public equities in healthcare, how do you think about the impact of technical change in the healthcare space? And just try to understand those two challenges of, the pace of innovation change. Who would like to take that first?
I'm happy to kick it off. Colin, you mentioned a few things that are important to us. And I guess I think about it as a spectrum sort of the investments we make. We do a lot of public fixed income. But when you think about that, long-term investing in public fixed income, corporations change over time. And certainly over a 10, 20, 30-year spectrum, a company can look very different than it did when you first made the investment. And in public securities, you have very little control in that, basically, just your ability to sell, hopefully, or get out of it. So that's why as we move down the illiquidity spectrum, we gain control that tries to account for some of those risks that could emanate over the long term. It starts, though, with just sound underwriting, credit underwriting, understanding the company, as we're thinking about, say, private debt in companies, understanding the company, understanding the industry, understanding the risk. An example, we've been factoring into our energy investment stranded asset concepts for years. Right. So you have to understand where industries could go and what are the issues that could impact them. But then what we do is we have the ability to essentially sort of negotiate more control. So we have, through covenants and terms and conditions, the ability to really step in and exercise more control if things really do start evolving dramatically from what we think would happen. And then the same thing would happen as I go down the spectrum again and thinking about infrastructure, project loans, that sort of thing. This is the same type of analysis where toll roads may look good today, but in 30 years, who knows how many people are actually going to be traveling on those toll roads. But again, a lot of it has to do with being able to foresee sort of evolution of the industry, but also being able to provide and build in protections as things do change.
Interesting. Thank you.
I think project financing as an asset class for emerging market has not been very well accepted by institutional investors, right? So one of the efforts we have to make is really how to turn those project financing into capital market products, eventually through infrastructure bond, project bond, that we can de-risk the construction risk and spread that risk premium onto the entire life so that the average cost is quite all right for the sponsor, but attractive enough for institutional investors. I think this is a big endeavor that we all collectively have to make happen. One example is in the country Colombia, where the government has decided, because of the indebtedness of the government, but meanwhile they wanted to build 8,000 kilometers of highway. So they actually introduced this 4G, fourth generation infrastructure, building this 8,000, but bid it out to commercial sponsors. To do this, they actually created a national development bank where IC became a shareholder. And the very reason is that using public a financial institution with better credit rating to backstop and de-risk project risk so that it becomes commercially viable, and then we can sell it to the pension investors, both domestic and abroad. I think capital market probably is the ultimate solution because institutional investors, in addition to long-term investment, they also want liquidity. They want the ability to exit.
Of course. Thank you.
So maybe just when I think about, I'm going to talk now about pharma and biotech, which is about 60% of the opportunity set for a healthcare investor. What I do every day actually is try to understand where medicine is changing. So we're making investments today based on what's going to happen and where medicine is going to be in 2025. And so how do we do that, and how then do we withstand the volatility of all on that path to get to where medicine is going to be in 2025, we just really have to understand how every disease is treated and understand the new biological pathways and really try to figure out where, which drugs will be successful. And then it reminds me of what you said earlier in terms of we're trying to create a portfolio of where healthcare is going to grow on a long-term perspective. So we have very low turnover. Our turnover is anywhere from 20 to 35%, particularly in even a lower turnover in the biopharma space. And that means we can do that, and we can have low turnover and make bets on companies and where we believe it will go because of our deep research and understanding of biology and medicine. That's what we do every day. I would say.
Could I just ask a quick question there? So do you work back from what you believe to be sort of long-term pandemics and very long-term diseases like obesity or whatever it may be, or cancer and different things like that, and then you kind of solve for that in the portfolio? Or how do you, because obviously you can't predict what the treatment's going to be, but you can pretty much say what the disease is going to be.
So,
right?
we focus on areas where we have interactions with every company in this space, so both public and companies that are private, that want to become private. So what we decide to focus on is really dependent on where companies are focused. So we have all kinds of clues. So what's in their pipeline, what are CROs working on? Those are contract research organizations. And we spend time reading medical journals, so leading edge medical journals where science is being presented early, and then medium-term medical journals where clinical data is being talked about in medical meetings. So that really, doing that sort of deep research will enable us to figure out what to focus on. Cool. So at any one point in time in my career, when I think about it, that's been one of the keys to being able to invest long-term, is to figure out where medicine is changing.
Got it.
5, 7, 10 years out, and that has allowed us to have focus, because medicine is not changing equally all the time.
I think it is also notable to what you were saying earlier about understanding the public equity markets and long-termism. I mean, not every public equity investor is made equal, obviously, in terms of their holding period and how they think about concentration and how they think about holding for the very long term and different things like that. So, there's a perception that everyone in the public markets is short-term, but that's not actually true, right? I mean, there are long-term investors in the public equity markets, and companies get the investors they deserve, right?
And maybe the other point is to say, so what is our relationship with companies? Because when I think about who are the best, again, the companies that create the most value, and I mean that by they're the ones that are going to have this cure for lung cancer, this treatment for this. The companies that have a mission, they're mission-driven, and they are focused on doing good for the world, and they have a governance structure within those companies that help them do that. Those tend to be the companies that have created the most value over my career. So we tend to...
So you guys are in agreement then, right?
We're in
Absolutely. I prepare the companies I prepare the companies that she invests in.
But even on a public space, there's a big differential between companies that have a mission and focus and have a good governance structure and how they run their companies. Right. You can really differentiate. And so that's what we're trying to do. And we tend to be shareholders of companies for, 5+ years. And we have long relationships with companies. And companies that turn out to be very successful, one of the things they often say to us is, we couldn't have done it if we didn't have a group of long-term shareholders. If we didn't have the long-term shareholders that had our same vision, then it would be hard to make the kinds of investments, the risky investments that they're making every day.
Interesting. So really what you're saying then is that long-term investing really needs to focus on kind of global challenges, if you like,
Yes.
because of the secular nature of the demand of solutions, right?
Yes.
Around
Absolutely.
the sustainability imperatives, basically. Yes. So Arif,
those global challenges that you've just described have been defined. They're called the Sustainable Development Goals. They're out there, and we haven't mentioned that word yet, right? However long we are into this panel. This is actually the problem that happens when we look at life in buckets, right? So there's that public bucket, there is the project finance bucket, there is the private equity bucket, and so on. But the reality is that you cannot build a great company unless you start with a good company. And you can't have a good company unless it embraces ESG principles, unless it has sustainability at its core, unless it understands what it's really set out to do. Okay, and I think if you take that to the other extreme and macro the statement that I just made, you will result in the Sustainable Development Goals. And the whole point around the Sustainable Development Goals, all 17 of them, is that they are actually a phenomenal investment opportunity. But the problem with the way investors look at this space, and I fear that I have to put a little bit of blame on the really long-term investors in what I'm about to say, because they are the allocators of the really long-term capital that can enable the Sustainable Development Goals to be met by the investors who are deploying capital. But they're not yet focused on that long-term opportunity. So if you look at the Sustainable Development Goals, you just take 4 areas within them. You take cities, you take food and agriculture, you take healthcare and education, you take energy. That's a $30 trillion opportunity. $30 trillion is a lot of money to put away. Okay, but guess what? It's even more interesting. If you just focus on those 4 sectors and sub-prioritize the real opportunity within them, that's a $12 trillion opportunity. In the next decade and a half, that will result in 400 million new jobs. This is not just me coming up with these numbers. These are actually statistics that have been figured out by people much smarter than I am. So the way I look at the necessity for investors like us, whether we're in the public markets or private markets, we have got to stop for a second, analyze and understand that it is not about the incentive schemes, it is not about the legal structures by which we operate. It is about creating value. And the only way that you create lasting value, in my opinion, is by focusing on 3 things. One is talent, the second is the ability to generate growth, and the third is to do so with the capacity to create scale. Okay, so talent, growth, and scale. If you hire the right people, incentivize them for the longer term. If you invest in opportunities that are completely focused on doing more than just the initial return, and you can create the scale, you will create the Alphabets, the Facebooks, and so on in the real world as well, in healthcare, in education, in energy, and that's where we need to go.
Absolutely, well said. And the SDGs are often referred to as a series of market failures, which need to be solved, basically.
But it's because we look at life in the impact space as being necessary to compromise on returns. That is not the case.
We agree with
the Abraaj Group is a clear example, and I don't want to turn this into an advertisement on what we do, but the reality is the returns that we generate are a direct outcome of taking that word called impact, centralizing it, and not compromising on our ability to both produce returns and do the right kind of investments. And actually, the world is very large. Many people can do that too.
We very much agree with you. We're going to go to you, and then Brian, maybe you could talk about some of the conversation we were having before about what you're hearing from your LP clients in terms of their interest in sustainable investing and impact investing.
Yeah, a couple of points. I think the first thing is that for private equity space, for mega debt financing project, you as an investor, you got to do your own due diligence. Yeah, that cannot replace, our due diligence, and we should do it. But there are many projects that are small, medium size, where you as an insurance company or pension manager, you don't have that bandwidth to do, but you miss big opportunities. Right. Many years ago, we invested in a tiny little bank in China, in Fujian province, right? And we helped them, with their ESG standard. We, improved their risk management, so on and so forth. Fast forward now, they are the 7th largest bank in China, 50th largest in the world, Industrial Bank of China, right? How can you, as a private equity investor, identify those early opportunities? But for debt financing of smaller scale, our kind of institution, I think our job is really to provide you with a vehicle so you can come in as more of a passive investor and take advantage of our globally diversified way of doing project financing. I think that's a space I want to call out to investors that you should pay attention to.
Great, thank you. Brian, did you want to?
Sure, yeah. To your earlier comment on sustainability, I think, and echoing Arif's point, I think increasingly we've seen that good businesses do things the right way. They take the right approach. They're holistic in what they're setting out to do. And I think there's a recognition that you don't need to sacrifice return in order to build good businesses that are doing good things. I think there's also probably a little bit of a demographic element in that today, too, where you see consumers making choices based on things that they didn't think about in the past as well, and that all ties together. So in our client base, we have seen a lot of interest in understanding what managers are doing to promote sustainability, how they're measuring it, how they're thinking about it, and we've seen institutions interested in capturing that and being able to report on it themselves. So for sure, this is a trend that we see continuing to expand.
And do you see, in particular in the private equity world and in the alternative asset world, there seems to be a lot of use of ESG when it comes to kind of operational excellence. Let's just say improving an existing asset that's maybe in the portfolio. But are you seeing more of a trend to more of the kind of Arif perspective on asset selection driven by sustainability? So thinking about, addressing these problems with genuinely sustainable solution businesses rather than just using ESG for kind of running a good company that maybe has a very negative effect on society, but is extremely well run. So are you seeing that shift?
Absolutely. I think people are saying the best assets, the best businesses have a lot of those characteristics embedded in them already. They were created for that reason. They're doing something to solve a problem, whether it's a long-term healthcare problem, whether it's an infrastructure problem. They are tackling that challenge, and so really it's a core part of what that business is. And those businesses grow at faster rates, and they are more scalable, and it really is a good opportunity for investors to come in and help them raise their game, continue to improve upon what they're doing, but take account of the fact that that asset really has those characteristics that are helping it. And
do you see where's the problem at the moment in terms of if your LPs are really interested in doing more in this space? Is there a problem at the asset manager level in terms of the amount of great product that's available for you to put to your LPs, or why is there not more money going into sustainability?
No, I think everyone's just figuring out that sustainability means a lot of things to different people. Everyone's figuring out what exactly it means. Everyone's figuring out how to measure it. So Arif can point to these businesses, but how do you take that and tangibly show your investors that you are capturing all these elements of sustainability that they're looking for? I think as data gets better, as people understand metrics and elements to focus on, that will continue to get better. But we're still in the early phases of that, it feels like.
Great.
I think we're still defining the empirical capacity to evaluate, right? We're still in that phase where we don't have enough empirical data to validate those data points other than the immediate feel-good factor. And of course, each of us has created our own indices and our own measures, but there isn't enough of an industry-wide standard to be able to come up with.
You mean in terms of the impact measurement specifically?
Yes, but it's quite interesting what Brian was saying, because there's also the definition of who the investor is. So if you look at the global investment banks and the capital that they raise in order to deploy into investment activity, they're very, very different from the allocators within pension funds and endowments. And the reason for that is more and more of them are beginning to reflect the wishes of their private clientele, either the parent generation that is beginning to think empathetically, or the younger generation that is totally focused on impact. So if you look around this room, less than 5% of the people in this room are going to be from the millennial generation. But those are the guys who are going to define activity going forward in the future. To Brian's point, you go into a supermarket, there are 3 bottles of water, you will buy the bottle of water from the company that you think is doing the most amount of work.
Or you don't buy the bottle of water at all.
Or you don't buy the bottle of water at all, right? But it's so important to be able to figure out where these trends are going. So the investment banks are much more obsessed with impact investing today than consultants or pension funds, and it's a catch-up cycle.
Great, thank you. It's helpful. So we've got about 3-4 minutes left here, and I wanted to see if there are any questions from the audience, given the quality of the panel we have here. Has anybody got anything they wanted to ask anyone on the panel, or I can ask a question, but wanted to give the opportunity to people. No? Okay. Maybe we could just run down the panel and give... Sorry, you wanted to say something? Yeah, go for it.
One comment, and this goes back to Arif. I like the way he described, sort of thinking about long-term sustainable companies, talent, growth, scale, and the like. But I think the additional point I'd make on that is we can have great companies, but if we don't provide the infrastructure necessary for those companies, we're never going to achieve the capabilities that we do have. And so I think right now at this point in time, I know the World Bank and IFC do a lot outside the United States on promoting infrastructure and the development of infrastructure. Right now we have a great opportunity here domestically as well in putting together an infrastructure program. And from a long-term investing perspective, I think this is a critical moment for us, and we have a great opportunity. There is plenty of capital that's ready to invest in infrastructure. It's really just designing the projects and designing the processes to make it much more efficient than it is today. But I think that's a great opportunity for us and really fits squarely in long-term investing. From what we do, we have over $40 billion globally in infrastructure investments. We now manage money for third parties, and they're all very interested in it as well. So we're at a critical time, I think, in providing the infrastructure that's necessary to develop and sustain those companies that Arif is talking about, describing.
That's interesting. And do you feel this, I mean, you know, I kind of hate to bring it up, but I mean, the sort of, you know, this Trump idea around the infrastructure renewal of America, I mean, what is your perspective on that? Given your point about, you know, infrastructure is a huge opportunity in the U.S.
I think the president recognizes the opportunity as well. I think, you know, over the next few months, we'll see how the program actually gets developed. But clearly, the opportunities are there, the needs are there, and the capital is there. We just need to put it all together into an implementable program.
Can I go one stage further? It's the single most exciting emerging opportunity on the planet today, US infrastructure. It's just a fact.
And so who is responsible for putting that package
maybe,
together?
Human genetics is.
All right, okay, well, wait. At least we have a debate going.
Sorry, who's just to your point about, you know, if the capital's there and the projects are there and everything's there, who is responsible for pulling that together?
Well, I think the administration will take a big lead in it. I mean, if you heard Secretary Chow or Secretary Ross yesterday, they both made comments about it in different forums, and I think they're working very hard to make sure that they can coordinate and develop the program that can be, as I said, implemented.
And so you feel there's still a need for some level of government intervention to help make that happen versus just private capital markets being able to do it?
Well, I think what we've realized, you know, as we've really sort of investigated this, is the biggest hurdle is really sort of getting from project design to actually shovel ready. It's all of the regulatory, permitting, and other processes that take place before you can actually start, you know, putting shovels into the ground. And that is a process where probably governmental authorities and administration have the greatest ability to try and collapse and streamline.
Interesting. Yeah, it's the kind of, why isn't JFK been renewed yet? And it's really about the Byzantine kind of local governments.
Everyone's using the statistic. The United States hasn't built a new airport in 20 years. Right. And in that time, China's built 70 or something.
Yeah, right.
Colin, there's a question out there.
Sorry, there is a question. Great.
Yeah, can you hear me?
Yep.
Yes.
So,
There might be a mic coming. Is there a mic coming? Yeah, there is. This guy's just 1 second.
But you're pretty loud.
yeah, hi there. I was interested in knowing your take, each of you or some of you, on the importance of impact investing in journalism and media, given the increasing understanding of the threat when there is fake news and there is not enough honest information circulating. Are any of you interested in that space? Because that is what our company is interested in.
Sure. Would anybody like, I'm happy to comment, but would anybody on the panel like?
It's safely above my pay grade.
I think we've seen at Generation on the private equity side of what we do, we've seen a surge in the last 6 months of stuff that addresses your exact question. You know, I think the whole sustainability debate has evolved. You know, it has come necessarily out of the environmental side, but is increasingly on the social side of things as well, and this would fit squarely into that. So, you know, just entrepreneurs who are setting up businesses to you know, basically counteract you know, the fake news and the control of you know, the editorial boards of very big media companies who you know, have got a lot of challenges themselves. We've certainly seen increased deal flow there. So I think there's plenty of early money going into that sort of thing, and it's not just impact money. I mean, there's a lot of VC and growth equity going into that, especially here in the US.
Behind you.
Can I just say that, you know, just make sure the awareness is there, that there are opportunities in emerging markets. I just came back from Myanmar, where some of our clients are doubling every year for the past couple of years. And so we don't read enough of those opportunities, you know, in the press here. So how collectively, you know, we could make sure that media is there to serve the investment community, so that opportunities are very well spread. I think that's quite important.
I would just plug my chairman's book called Assault on Reason, which I highly recommend. It's Al Gore's best book, and it is all about the assault on reason that's happened in the last decade or so. And he's actually just republished it in a Trump context. And Gore also has a new movie coming out this summer, inconvenient sequel, which is basically it's called Truth to Power, which touches on a lot of the issues that are inherent in your question.
Could I just add something, please? If you go back to using the question as a bit of a cornerstone, and you go back to thinking that in order to create sustainable long-term value, we can actually go beyond and the sort of parameters of sitting inside boxes and buckets and soar a little bit and start to think it's not about emerging markets, it's not about developed markets, it's not about public markets or private markets. It is about creating a better world by harnessing and taking the talent that is available of the people in this room, of the people outside this room, of the opportunity that is inherent in the investing industry, to actually not just tackle and focus on changing the world from the perspective of the Sustainable Development Goals, the new businesses that are emerging, that are going to create technology that will make life a much simpler exercise to navigate than in the past. And I think that if we all start to think a little bit more collectively and cohesively, then we will emerge with new models even in the investing space. We will do it. It won't come up as a directive on a tablet on a burnt-out mountain. It will be us that will figure it out. Right? And I think we should put that challenge to ourselves in exactly the same way that we embrace the development of technology, the way we embrace the iPhone, the way we look at everything that we have today which wasn't there 20 years ago. And we do that in our space. I think we will be the front runners of changing the way the world thinks. And the financial industry will actually be part of that staggering spurt forward.
Well said, and I do believe that many of the historical asset allocation models, are not addressing your point, and do need to evolve. And we've certainly seen in the sustainable investing world over the last 15 years or so that some of the very early investors in sustainability were people who had the flexibility to break through traditional asset allocation models. And that if we can show at scale that sustainability pays, which is what many of ours mission is. That will help evolve asset allocation models to a point that they need to get to, which reflects the more holistic nature of value creation. We have a few minutes left. We have another question over there.
So we've heard the panel speak a little bit about structure. One of the things that actually hasn't been mentioned is size with respect to structure. I think IFC data clearly indicates that they've done far better investing in SMEs, smaller businesses, first-time fund managers. There's about 16.6 million private companies in the BRICS. When you break them down by revenue allocation, about 99% of them have less than $2 million of revenue. It seems to me that most traditional investors are focusing on unicorns. What are you guys doing to address that?
Scale and infrastructure is pretty big. Wellington's pretty big.
Wait a minute.
As a fixed income investor, though, those companies generally are not going to be of the size yet where we're comfortable investing.
For us, the most efficient way, you're right, absolutely right. SME has to be the engine of job creation growth. So for us, scale is a challenge, and we support SME primarily through encouraging banks to lend to SME so we can risk share, we can offload some of their assets. One of the latest example is our work with Alibaba, where we help to securitize their microfinance and loans to offload that onto capital market. And what's exciting is that the loan characters now are all big data driven, so that we can do it much more efficiently. I think digital finance combined with the ability to support SMEs, I think will see this sector grow very rapidly. Let me just add one more thing that is a secret sauce of success, is that because we only invest in emerging market countries, we actually have more people in the field than in Washington, D.C. In sub-Saharan Africa, we have over 500 people, because otherwise you can't really understand the context of investing without having people on the ground. The second is that we have more people advising. We have 1,000 people advising solve upstream problems, right? Whether it's PPP, whether it's ESG standard, whether it's doing business efficiency, than actually deal makers, which we only have 900. So we are here to solve the upstream problem so that the sustainability question is addressed by working with government, working with private sector on that. And then the deals will flow. So.
Great.
But
Thank you very much.
Could we just in 10 seconds answer the question?
Please do, yeah.
He's actually right.
Yeah, sure.
Because without investing into SMEs, we're not going to be able to achieve most of the developmental targets we have out there. It's just different people are going to invest in it compared to the people on this panel.
Sure, absolutely. Well said. So we've been instructed quite overtly here to please wrap up. I wonder whether, can you give one takeaway for the audience from this conversation, please? Brian?
Well, I think we'll leave very optimistic that there's terrific investment opportunity out there, that people are starting to think about really how to focus on the long term and solve problems and create great businesses, and that there's a way for all of us to benefit as consumers and investors and participate in an exciting future. So it was great to see that across the panel.
Thank you.
There's a lot of capital, a lot of opportunities. Putting it to work is the challenge for us all. And I think it's a little bit ironic that the fixed income investors are the longest term investors on the panel.
There is alpha to be made in emerging market. There is $8 trillion sitting in negative interest rate. How can we as a World Bank Group, international community, to de-risk, to design those projects so that it will be commercially viable? That's what we are focusing on.
Great, thank you. Jane?
So I guess I would say that I think we have corporations all around the world. We have investment managers like Wellington, and we have asset owners, and there could be a greater partnership between all three of them to align our interests so that we do create these companies that do good and solve problems.
Great.
My feeling is that there's enough idle capital out there that is underutilized. We hear about tons of money being released in Japan that is not currently looking at investments, that is just sitting in bank accounts. And I feel that if we can channel some of that idle capital into thinking more proactively about the needs of our global community going forward, then we'll meet the needs of infrastructure in the US, we'll meet the needs of infrastructure globally, we will achieve the sustainable development plans, and I can go home from work an hour earlier.
You never go home, though. So, great. Well, thank you all for a terrific panel, and appreciate it. Please help me thank them.